Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. My name's Rachel, and with me today is David Blake, CMT, here to discuss last week's market activity and what to look for as we go into the market this week. David, how are you doing today?
I'm doing well, thank you.
Great, let's jump right in.
Well, if you just tuned in last Friday afternoon, you would think nothing happened last week because the major averages pretty much were flat at the end of the week. But it actually was a very volatile week. We had a busy week with earnings. Some of the Mag 7 came out. We had the January FOMC meeting with the Fed chair press conference afterwards. And in between there, we had quite a lot of volatility. We actually had the S&P 500 and the Philadelphia Semiconductor Index make new highs on Tuesday. The Dow Jones couldn't quite keep up, and that was basically because they had a earnings from United Health Group missed, but also we had the White House announcing some kind of new proposal for Medicare Advantage payments that sent medical stocks really reeling. Molina Health, Humana, CVS Healthcare, they were all sharply lower, and that weighed on the broader market as a whole. And in fact, after everything was said and done, the Dow and the NASDAQ were down for a third straight week, while the S&P 500 eked out just a small gain. So you really went out of the 4 weeks for January. We still ended up higher for the major averages and the secondary averages, but we just kind of drifted lower as the month was going on. Just kind of lost some upside momentum and really didn't do much after the first couple of weeks. You can go over here if we look at a chart on the, let's just take a look at, say, the diamonds. As you can see, pretty much sideways action all the way through January. We did have a small profit. Let me get rid of this tooltip. But it pretty much tested the lows here mid-month, went up, and just kind of going sideways. So I was stuck in a trading range, which we'll kind of keep an eye on that. If we take a look at the SPY, kind of had the same thing. We're moving here sideways. We're actually about where we were in mid-November. So we're not making a lot of headway. We did finally crack over this high from back in October, November, but not with a lot of oomph. Now, we also saw this thing come down mid-month. This end, the NASDAQ broke their 50-day moving average, which is something that we want to keep an eye on. I thought today there was a chance that we could see that happen again, but this morning we opened up a little bit lower. The S&P 500 and NASDAQ came down close to their 50-day moving average again. So that kind of held support, and now we're having a nice little bounce here this afternoon as investors are kind of moving back in. We did have a scare last week with gold and silver. Both of them actually were hit hard. They'd had these parabolic moves. I think it's, let me see here. Okay, here's one of the silver charts for this. And when you see a parabolic move like this, it never ends well. I can tell you that, whether it's a stock, whether it's an index, whatever it is, at some point when you see a move like this, especially when you start getting gaps, you need to start thinking about taking some money off the table. And that's exactly what we had when we finally ran out of steam, had that pullback, and then it continued on Friday. And gold had the same thing, not quite as severe as silver. But again, I just want to tell you, when you see moves like this, they don't end well. And this was as soon as they start to gap higher, that means you're getting short covering and stuff like that and margin calls. And that's when they're going to pretty much come close to peaking out. So that's something that you want to watch. This is the NASDAQ. And again, the NASDAQ has been going pretty much sideways all through November, December, and into January. We're up again today. It still hasn't made a new high from where it did in October. That's something we want to keep an eye on. It needs to crack through there if the whole broader market's going to continue to make new highs. So, we're kind of running out of steam here on this rally from April all the way through here. And we're kind of getting a make or break situation coming in here. One thing to note is that our CTI model, which measures cycles in the market, we are actually scheduled to go to a -3 next week. And it's going to stay a negative configuration probably for 4 to 6 weeks, which means that we're going to have downward pressure from the cycles on the market too, which again is going to make it a little tough to break out with much momentum to the upside. So I would be looking to maybe sell some covered calls in here, things like that, because economically and what's happening underneath the market still seems positive, but it doesn't look like we're ramping up to have a big breakout here. It looks actually the other way, like we're going to maybe drift a little bit lower going forward. some other things we saw last week with earnings. One of the big deals that we just talked about, besides the healthcare stocks, we saw Microsoft came out. They disappointed on 38% growth in their Azure, however you pronounce it. The stock was down more than 10%. Now that was offset somewhat by Meta Platforms, where they came out with their earnings and it jumped 10%. So that kind of balanced each other. So far, you have about a third of the companies in S&P 500 have reported, and on average, they're coming in up about 16%. And according to FactSet Research, who usually has the earnings estimates ahead of time, they were only expecting about an 8% earnings growth. So we're just blowing away the numbers. But as we talked about last week, you're not seeing the stocks react to the earnings like you would expect when they're beating like this. They're kind of going sideways to maybe even down a little bit, despite what they do. You had Disney this morning come out and they beat their earnings estimates, and the stock was down 6% last I looked. Now, part of that is also because Bob Iger is getting ready to leave again. That's kind of rattling things a little bit here. But still, the fact that they had good media growth, that kind of stuff, streaming media, but the stock again was down about 6% earlier. So when you see that, it's showing you that the market feels like things are fully priced. If I beat my earnings estimate by 20% and my stock stays flat, it's been built in. And that's what we're seeing right now, again, which is probably keeping a cap on what we're going to see, even with better earnings. Now, also this week, we have Amazon is going to report. We have Alphabet is going to report. We have Palantir tonight. Palantir was one of the big winners from last year. Advanced Micro is going to report this week. And I imagine you're going to see fantastic numbers coming out of these companies, but you're going to watch them. And I don't expect any of these companies to really zoom off the charts here and head sharply higher from what they're going to have, because they've actually, they've ran up into the earnings estimates. And the only thing you're going to see is that on a disappointment, you're probably going to see a bigger drop. So I know a lot of traders are buying puts just as a safety net underneath some of these things. So even if they do come out with a nice report, they can still drop 7 or 8%, and they can maybe write that off with their puts to keep things going. All right. As far as the technical condition of the market, it did deteriorate a little bit last week, like we've been talking a little bit here. Again, the Dow and the NASDAQ were down for a third straight week. The S&P, just a small gain. It was up, I think it was up 27 points, and that's nothing to write home about. The secondary indexes were mixed. You had the transportation index and the Philadelphia Semiconductor Index higher, but the Russell 2000, the small cap index, was down 2.1%. Part of that, again, is the Russell 2000 small cap index is one of the main benefactors of lower rates. And as we've seen here the last 2 weeks or so, rates are stubbornly high, and they're sitting up here at the upper end of their range where they actually were back in September before we started having some of these cuts, right around 4.25. I think today we're at 4.27 for the 10-year. So that's something you want to watch. If it breaks up much more than that, that's another source that's putting downward pressure on the major averages, which is going to, again, cap gains going forward in here. Another thing I've noticed, we did see a new high on the NYSE advanced decline line a couple weeks ago. But if you go back and look at some of the commentary from the past 3 or 4 weeks, the NASDAQ lost 3,000 units in its AD line, but the NYSE AD line has almost been flat for like 3 weeks. It's going back and forth, and you don't see that very often. Normally we'll have a couple up days, and the AD line will pick up a couple thousand units and lose a couple thousand units, something like that. If we go over here to the market at a glance, which you should actually go to maybe on Saturday morning or something if you're looking at your portfolios to see how things are going. You'll look over here, and these charts are basically kind of like a stock chart. You can draw resistance lines and support lines and that kind of thing. As you can see here, if you're looking for a breakout, this is not a sign of an index is getting ready to break out the new highs. And over here, this shows you, at the end of January, we came in there when it was really going, but then we ran out of steam. So these are something that you want to kind of look at. This is probably showing, you wouldn't call it negative divergence at this time because the market's not going anywhere. But if the market was going higher on the Dow and had the AD line like this, then you would consider that negative divergence, which would be giving you a warning that the new highs probably aren't going to hold. Now you go over here, we just talked about the NASDAQ making a new high back in October, which was right about here. And it has not been able to do that since. And you can see that the AD line, we talk about that spreading out. Well, on the New York one, you saw this line in January really taking off. That was a rotation out of the tech stocks into the cyclicals, the materials, and some of the energy stocks, the banking stocks, and that type of thing. Well, this here is showing you that rotation that we're seeing that's pushing the S&P 500 and Dow to new highs is not happening to the NASDAQ. That means you're seeing the tech trade rolling over a little bit. So that's a sign here. This is not an AD line that's telling you that the market, the NASDAQ's breaking out to new highs. Again, another sign that we may be getting a little bit toppy. But this is a little bit different. You have seen some expansion in the new highs versus new lows. Until Friday, you really had a big drop off in that. So this is supportive of some higher thing. But this again is showing rotation when you're having that rotation out of tech and then into some of the stocks that are cycles and sectors that were not leading. You're just seeing these numbers grow as you're starting to see some of those stocks start to pick up steam here. But going back a little bit further, another thing I did mention is you want to keep an eye on sentiment in here. Again, we're getting close to get to not irrational exuberance, but we did see the retail investor. They're above their bullish sentiment for 9 out of the last 12 weeks. Normally, the retail guys, according to the American Association of Individual Investors, they're usually about 37.5% of them are very bullish. And that is, we've been above that now with 44.4, like I say, 9 out of 12 weeks. So that's a little bit overly bullish. We also saw FINRA report a December margin hit another record high. That's the 8th consecutive month of increased debt balances and customer margin accounts. That means that investors are chasing the rally. They're seeing the major averages make new highs. So they're buying every dip. If the market does start to roll over, all of a sudden you start getting margin calls, and that will accelerate downward pressure on the market. So that's another warning that we're seeing right here, that we're probably getting a little bit toppy. And then you had even the hedge funds, according to the National Association of Active Investment Managers, they're about 92.6% invested, and they've been like that pretty much for about 6, 7, 8 weeks. They're not quite rolling over on the margin, but again, when you're having that much, when you're staying fully invested like that, it's another little bit the sign that things are almost getting out of hand here, and it's just another sign that you want to be a little bit more cautious in here. And that's again, the main thing I'm trying to express here is that the market is looking toppy, and there's a lot of underlying signs that you should pay attention to from experience that shows that we're not getting ready to break out to the upside here. Now, this week, again, we have a big earnings slate. We're going to have Palantir tonight. We have Disney this morning. I think, let's see, we have Advanced Micro Devices. We have Merck tomorrow, Alphabet and Lilly on Wednesday. We have Amazon, Bristol Myers, I think, on Thursday. And then on Friday, we get the BLS jobs report. It's been very steady for the last month again. So that's kind of keeping rates a little bit higher. So that's where we are. Again, the CTI, which has had a great track record of calling weak and strong periods in the market, is getting ready to flip over to a negative or bearish market posture. If everything still looks good, we could go to a neutral posture, but I imagine we'll probably go to a bearish posture here in the next couple of weeks. So at this stage, maybe you look at the covering yourself a little bit with some selling, some calls, maybe get a little downside protection. And I wouldn't be looking to be aggressively buying stuff, but just be relaxing here and just let the market see if it's going to pull back. Usually before we have a little bit of a pullback, you'll see everybody jumping in and buying the dips. I'm not sure I'd be a dip buyer right at this stage, because I think the risks are to the downside now rather than missing out to the upside. And that about wraps it up for this week.
All right, very good. Thank you so much, David. Is there anything else as we go into this week? I know we've got some earnings coming up, some labor reports coming up. Anything else that people should be looking for that may make them want to change their strategy or jump in or out of anything?
Yeah, just watch the earnings. Again, what I mentioned earlier, we are seeing where the companies come in and they beat. And if they do jump, they sell off pretty quickly. Like Meta. Meta jumped up 10%, and then you had people selling that jump. So if you were thinking about buying, say, a Meta, and you get the earnings come out, they beat, you see the stock going up, some people would go, oh, I need to buy that now. Just kind of watch them right now. Again, they're not holding their gains if they do have a little bit of a jump after they report. And that tells you that that's not mom and pop that are taking the profits off of that. That's the institutional players coming in and saying, okay, we were hoping for this, and we got what we wanted, and we're going to take some money off the table in here. And when you see that, that's a sign that you're very near the top. And even if they are, even the companies that are offering forward guidance, you're not seeing them make a big run either. More or less the hedge funds are saying, okay, that's what we're expecting anyway. We're not going to move on this from here. So that would be something again that you want to watch.
Very good. All right. We'll keep an eye out for those earnings. If you have questions for David or anyone on the MarketEdge team, feel free to reach out to us at support@marketedge.com or drop a comment below if you're watching on YouTube. That's it for this week. You can check out marketedge.com to get technical analysis on over 5,000 stocks and ETFs by visiting us at marketedge.com. Your first 2 weeks are free. We'll see you there. Thanks so much.